What do George Soros, Michael Burry and Bill Ackman all have in common? They've all made fortunes on shorting, meaning betting on an investment to go down instead of up in order to generate returns. During times of uncertainty like we have now, a lot of people are wondering whether it's a good time to short the whole market.
Possibility of recession for what felt like, a very, very long time.
In this video, we'll be looking at how you can make money if the stock market falls, and we'll talk about one super simple solution you can use to short the whole market without taking on too much risk.
You smell that? What is that?
Opportunity.
Let's quickly explain how shorting works. Shorting means instead of just buying and selling an asset, you borrow it from a broker and sell it. When the price goes down, you then buy the asset and return it to the broker. The difference between the initial sale price and the lower purchase price, minus any borrowing costs, is your profit. The catch is that this involves timing your position well. It's not enough to think that a company or the whole market is overpriced, but in order to make a successful short sale, the price actually needs to go down, otherwise you'll be losing money. Hopefully that's clear. Now let's talk about the strategy to make some stonks in case the S hits the F. The short market portfolio is designed to make a profit when the whole stock market falls. This strategy is great for investors who are cautious about current market conditions and who would like to benefit from potential downturns without taking on excessive risk. This is a mix of inverse and safe haven ETFs, which aims to provide a balanced approach to shorting the market. It's made up of 4 ETFs, each one with a specific purpose. And let's look at them one by one. The ProShares Short S&P 500 ETF, ticker SH, 30% of the portfolio. This is an ETF that tracks the inverse performance of the S&P 500 index. In other words, when the S&P 500 falls, the SH goes up. By including this ETF in the portfolio, you're effectively betting against the largest companies in the US. The next one is ProShares Short MSCI EAFE, ticker EFZ, also 30%. This ETF shorts the EAFE index, which tracks companies across 21 developed markets around the world, excluding the US and Canada. When the US economy is struggling, foreign economies are likely to struggle as well. By holding this ETF, you're shorting international stocks, diversifying your exposure to various economies. Then we have the ProShares Short High Yield, ticker SJB, 20% of the portfolio. This ETF is inverse to short-term high-yield bonds. When the market goes down, high-yield bonds usually perform more like stocks than bonds. This short ETF profits from falling high-yield bond prices. This adds a layer of protection to the whole portfolio. Finally, the abrdn Physical Gold Shares, ticker SGOL, also 20% of the portfolio. Unlike the other 3 inverse ETFs, this is a long ETF that invests in physical gold. Gold is a safe haven asset that tends to hold or increase its value during market downturns. The idea behind this portfolio is when the stock market falls, the first 3 inverse ETFs go up. The SGOL ETF benefits from an increase in physical gold prices. It also helps to smoothen the portfolio volatility when markets recover and short ETFs lose value. While the idea behind it is to maximize gains during market downturns, the SGOL ETF also helps to limit losses during market upswings. That way you benefit as much as possible from the downturns, but it gives you more time to react when the markets go up. For example, if you had invested in this portfolio in March 2020 during the pandemic meltdown, you would have made over 6% that month compared to the market drop of 15%. Still pretty great, but of course, past performance doesn't equal future performance. The good thing about using ETFs like these to short the market is that, well, apart from not having to do everything manually, shorting single stocks gives potentially unlimited risks if it goes the wrong way. If the stock you're shorting goes up by 300%, you'll lose 300%. With short ETFs, the most you can lose is the value of the ETF, so 100%. Once again, while this approach is designed to perform well during downturns, it's not suitable for investors who are looking for growth during bull markets. This is a pretty advanced short-term strategy that comes with higher risk, but with all these videos saying how the market is going to collapse by the end of the month, this is an approach that can give some good results. If this sounds like a strategy you'd like to try, you can either buy all these ETFs yourself in the right proportions from your broker, here they are once again, or invest in the portfolio as a whole in just a couple of clicks in Gainy. Thank you for watching, and don't forget to subscribe to our channel for more investment insights. All the best and see you soon.